All right, thank you for joining the Investors Gate podcast. I'm your host, Austin Denoche, and today I'm going to be talking a little bit about portfolio allocations, more specifically the 60-40 portfolio allocation. So I'll explain why I think it's no longer a viable strategy and where investors can look to safely and effectively diversify their portfolios in this changing economy. All right, let's do it. So traditionally speaking, people have chosen to allocate roughly 60% of the portfolio to stocks, equities, and roughly 40% to bonds. Warren Buffett is famous for advocating that, and it's been a safe method of diversification for a while. In the previous macro environment, it made a lot of sense. Interest rates were declining, and so there's been a roughly 40-year-long bond bull market. And so that has worked well in tandem with equities. But I'm here to talk about how I think that's dead given the current economic environment we find ourselves. The fixed income market, bonds, right now are nominally barely yielding a rate. And if you account for inflation, the real return is like negative 4%. So in other words, bonds are guaranteed to lose you 4%. Not exactly the most ideal investment. And cash is even worse. I mean, at least bonds try to give you some nominal rate of like 2%, whereas cash is, you're not getting anything. You're just losing whatever the inflation rate is. So it really has increasingly become more and more of a liability as inflation persists. And, as I just discovered earlier today, the CPI was over 6%, 6.2 to be specific. So this is very real stuff, especially when you consider the CPI rate that the Fed uses, which is based off of a very selective basket of goods, is hardly the real rate of inflation. In reality, if you use the CPI approach that the Fed used prior to the 1980s, the rate returned through that method would be over 14%. 14% is a lot. Imagine losing 14% of your savings every single year by doing nothing but holding cash. And, close to that if you're holding bonds. So given this environment that we're finding ourselves in, I think it would be prudent for any investor to explore other options. How do you protect your money? How do you think of a portfolio allocation in this current environment? And I'm going to be talking about a few different areas you can diversify into. There are obviously a lot more, but these are my personal favorites, what I would suggest to someone who's trying to navigate this confusing environment. So first, you have precious metals. Next, you have crypto, commodity correlates, investment hedges, and then finally, emerging markets. So we're going to go through those one by one, explain a little bit more about what they are, what that means, and how you can go about it. So let's start with the precious metals. The most obvious precious metal to go into would be gold. It's a tried and true inflation hedge. It's an excellent store of value, and people generally have an understanding of what gold is and how it can protect you. Other metals could include something like silver or platinum. If you're expecting to do a large allocation of precious metals, it could be a good idea to dip into some of those other ones like silver or platinum or whatever, just to diversify within that space. But precious metals in general are a great way to diversify your portfolio. I think anyone realistically should probably aim for 5 to 10% of an allocation, especially given the inflationary environment. Gold may not perform exceedingly well in deflationary periods, but it will perform very well in inflationary periods, and it seems to be poised for that given what we are headed for in the next decade. Inflation is likely to persist pretty dramatically, or at the very least persist above expectations of 2%. So it would likely be a very good investment to consider. So next we have crypto. So this is my personal favorite, and I know it may seem a little too Wild West for a lot, which is understandable because it is this nascent industry and, whatever. There's all this misinformation about it. But I think every investor should have at least 5 to 10% allocation to Bitcoin and or other cryptos. I personally would probably trade the whole 40% bond allocation for crypto, but I understand that's not for everybody. But Bitcoin is like digital gold, for someone who's not sold on it, just think of it like that. It's a pretty apt analogy. It's a store of value. It's a scarce asset. And very importantly, it's not correlated to any of these other assets really that I'm mentioning. And that's one of the best methods to securing your portfolio, is diversifying effectively to where it's not all correlated. So the less correlation you can have, the better in some sense. And Bitcoin offers that. And it's a very unusual store of value because it's almost like a tech stock that's also digital gold. So I would recommend definitely considering it. Just the fact that it's appreciated around 200% per year since its inception should warrant at least a 1% allocation, even if you're the biggest bear. If you were a bear 10 years ago and you just did a 1% allocation, it would have outperformed every single thing in your portfolio, bar none. And ignoring that, I think, is just not being smart and not looking at the data objectively and being like, how can this help my portfolio? So I would recommend definitely considering Bitcoin as an excellent inflation hedge, store of value, just like gold or other precious metals, but also just the network effects and the fact that it's similar to a tech stock just gives it so much more potential to hedge your portfolio against all the fiat denominated assets and just offer a lower correlation to the rest of your portfolio in general. Now, if you're already sold on Bitcoin or crypto, you can dip your toes into some of the other altcoins. Maybe like Ethereum is obviously a really good one. Solana, maybe Cardano, Polkadot, whatever it is. Just do your research. You can even go into some of the more obscure altcoins like Rune, Aave, Matic, whatever it is. Just understand the further you go down that list, by market cap for all the cryptos, the more volatile it is. So if you can't stomach it, I wouldn't recommend it. But as an asset class, it's a great opportunity for alternative exposure without similar correlation. And just given the whole bond fixed income debacle right now, your options are somewhat limited. So this emerging asset class couldn't have really arisen at a better time. So highly recommend checking it out. If you're not interested in it, at least consider a 5 to 10% Bitcoin allocation. So next we have commodity correlates. Now, what the heck is that? Well, commodity correlate would really be anything that moves in the same direction as some underlying commodity. For example, like a gold mining company roughly trades on par with the price of gold, going up, down, sideways, similar to something like an agricultural stock that moves up and down with corn or wheat or coffee. Energy companies that move with oil prices or natural gas or something like that. Because getting exposure to actual commodities is a little difficult unless you want to buy like futures contracts or something, but that can get complicated. So it's probably easier to just go for something that's very highly correlated to the commodity itself. And commodities in general do not perform super well. They go through these kind of boom and bust, but when they go through booms, they outperform nearly everything else. And I think the next decade, just with the inflation going on, shortages, all the craziness happening in the world, commodity markets are very possibly going to see one of their better bull markets. So definitely look into that. There are a number of different ways, as I mentioned, you can get exposure to these kinds of markets. I would try to look at the actual commodities if you can, see how they trade. Like maybe look at a chart. That's probably the easiest way to get a visual idea. Are they correlated? Look at the company. Are these two charts moving kind of in tandem with each other? And do that for whatever commodity you're most interested in. If you want to be in gold mining companies, silver mining companies, copper or something, lumber, agriculture, water, I don't know, anything that's correlated with the actual commodity you're trying to get exposed to. There are going to be a ton of options out there. And this may seem almost like you're adding more exposure to your equities, which in some sense could be true, but it should more accurately be viewed as gaining exposure to commodities, which is a separate asset class. So it may seem like you're just now, whatever, like 65, 70% in equities. And although technically may be true, definitely focus on what those equities are moving with. Are they kind of moving with the market in general or with commodities? And because at the end of the day, you're just trying to get away from the over correlation by being overexposed to traditional equities. All right, next we have hedges. This is fairly straightforward. If you say you're overexposed or highly exposed to big tech, like Apple, Microsoft, or the FANG companies, you could have a portion of your portfolio allocated to something like SQQQ, which is just a short of the QQQ big tech companies. And that's something to look at. I mean, there's plenty of different short funds or ETFs that correspond to maybe something that would be in your portfolio. So whatever it is you are heavily exposed to in your portfolio, I would just recommend trying to look for some sort of short alternative to hedge that position in the, whatever, maybe unlikely event that those companies go down. You can also do this through selling calls or buying puts on positions to hedge yourself. That's you have to play with time with that, so it's not necessarily like if you're expecting a quick move in the next month or couple months, relatively short term, then you could look into hedging your position with some sort of derivatives options. But other than that, it'd probably be easier to just do a fund. That way you don't have to time it. It can be a little bit more passive. And a good way to go about measuring how much to put in what. Say you are, whatever, 90% confident that these tech companies are going to go up over the next year, then maybe that can mean 90% of what you would put into that investment goes into that investment, but the 10% goes into the hedge position. And you don't have to be that exact with your confidence levels, but it can be a good metric for figuring out exactly how you want to allocate within that. So yeah, investment hedges, a great idea. The only thing I should mention though is even though it technically is lowering positive correlation, it is dramatically increasing negative correlation. Like, so even if stocks are doing well or your big tech companies are doing well, your short position in, say, SQQQ, for example, is not doing well because it's the opposite. It's negatively correlated. So it is a good thing to do insofar as you're going to mitigate some of your up and down days by having that hedge position, but you're pretty much guaranteeing you're not going to make as much money if it goes up. But still, it's safe investing, and if you're trying to find a home for a certain percentage of your portfolio, it's a good idea to consider. All right, finally, we have emerging markets, and this is a really important one, especially because in America, or really any country, I guess, but mostly America, we have this very, America-centric view, and we only really focus on American company stocks. Whereas there's this whole other world out there, nations like China and Russia and India have booming economies that are really primed or poised for exceptional growth over the coming decade. And it'd be a good idea to get exposure to that. Number one, because investing in their main indexes, like their versions of the S&P or something, it offers you a similar exposure insofar as it is a similar basket of companies, like what would be in our S&P. But it's not correlated to U.S. markets the same way the SPY is. I mean, SPY is U.S. companies. So if you're investing in, something like the Nifty 50 in India, those companies going up, they're similar companies to what's in the S&P 500. So if that is what you find comfortable investing in, you can still get that in these other emerging markets. But, when the U.S. market is down, it doesn't mean India market is down. In fact, over the next 10 years, it could be the opposite. I mean, as U.S. markets slow, a lot of these other booming nations. I mean, you say emerging markets, but India is so big right now. I mean, their population is about to outpace China, which is another reason to consider it as an investment because those demographics are going to have a very material effect on their growth as an economy, and absolutely worth considering. And you don't have to be an expert looking at specific companies in a foreign land. You can do that, but there are risks associated with that being, worlds apart here in America and not really being connected to that market or that economy. And so to keep it simple, I would focus more on the major indices in these countries, whether that's the, like the Nifty 50, I forget the name of the Chinese index. Then you have the IMOX for Russia, which would be another good one. I mean, I would say Russia, China, and India are probably some of the best, quote unquote, emerging markets to consider, just given their growth opportunities. But if you want to get more specific outside of the indices, you obviously can. A good example of that would maybe be Russian energy stocks. Those are poised to do very well over the next decade. Energy in general is poised to do very well. But yeah, emerging markets, very important. So absolutely consider a 5 to 10% allocation to that. Maybe even take some of what you would invest, put in equities, and just put that into some of these emerging markets. All right, so depending on your preferences towards all these different asset classes or opportunities, you could be looking at a 5 to 10% allocation to precious metals like gold, a 5 to 10% allocation to crypto, Bitcoin, 5 to 10% allocation to commodity correlates, 5 to 10% allocation to investment hedges, and a 5 to 10% allocation to emerging markets. Now, this is by no means a strict suggestion. I encourage anyone to look into all these different opportunities more deeply to find out what interests you the most or what works with your portfolio. For example, you could really just want to be all equities, or you could want to maintain your 40% or still pursue a 40% bond allocation, or near 40 and then only dip your toes into some of these a little bit. Although I would strongly suggest against that, given the environment of the fixed income market, as mentioned, because as long as interest rates remain low and inflation persists, you're guaranteed to lose money in cash and bonds. That's just the truth. And so you're going to want to stay away from that. It's just not worth it in the end. Even if you don't want to fully go into these different sectors, asset classes with this large percentage of your portfolio, I would consider maybe averaging in, or at least thinking about it, or going into one or two. Maybe you just want to start with a 5% gold allocation because it's easy, it's simple, you know gold, you understand gold. But take that away from the bonds if you're in there. Or if you just are mostly in equities and you're like, how do I not be 100% long equities? Because that can be dangerous, especially if we are in this kind of bubble-ish territory, and you just don't want that. You want to start diversifying now to avoid some of these crazy correlations where it's just all in, all out. But you can take it slow, take it simple, do little baby steps, just add a couple percent here to this. You like this mining company, boom. You want to get a little bit of Bitcoin, just 1-2% of your portfolio, boom, pretty easy. Maybe you have a lot of confidence in India becoming this crazy booming economy in the next 5 years, and you want to just buy a little bit of Nifty 50 every month or every week or whatever it is. There are a lot of ways you can start piecing elements of this strategy together, and that's all that I'm really trying to get out there. Just it's important to think about these things because, in schools, they're still teaching students, kids, the 60-40 allocation strategy. And they're just leaving everybody so ill-equipped to tackle this changing environment. And it's dangerous. We need to think of how to reimagine a portfolio in this new world where, the traditional approach just doesn't work. And, as I mentioned, these, I believe, are some of the best places to look, at least over the next decade, given inflation and everything. So don't let tradition have an adverse effect on your portfolio. Think about these things, think deeply, don't make any rash decisions, but look for these opportunities and try to start making moves towards exposing yourself to them, because you don't want to think, oh, I should have done this. Why didn't I do this sooner? Because it's going to be obvious soon, and you're going to regret not diversifying or finding some sort of way out of this end game that has you stuck in just losing money in the bond, fixed income, cash world. But you don't want to put all your eggs in one basket. I mean, it's going to be dangerous, especially in the bubble-ish territory that we're in. So thank you for listening. I appreciate it, and best of luck.